Good afternoon. This is Tom Alexander. It's Saturday, August 27th. It's about 4:20 p.m. Eastern Time in beautiful Charleston, South Carolina. Big day on Friday. Has a lot of implications. Let's start with some general advice. Friday was a wonderful lesson in not getting caught up in a narrative. It's very, very easy as a trader to listen to outside noise, watch CNBC, look at Twitter, watch the cable channels and all the news. There's always some narrative. And always remember, and I've been trading for 38 years, and this is sort of a note to self. Always remember it's about following price action. Auction market principles give us the most objective, consistent view of market behavior you're ever going to find. Can you always know what's going on? No, you can't. But there are certain things you can always do. You can, for instance, keep from being on the wrong side of the market for long. And you will always find eventually the market will clear up and it will fit an auction market phase of development. There are three primary phases of development in an auction market process. A step one, which is a trend, a distribution range in market profile terms. A step two, which is development around a stopping price. Or step two is a stopping price, and then step three is development around that price, and then the process starts over again. This was outlined in real time, elegantly by the market on the way up. Now it looks like we're on the way down. What Friday is telling us now, let me show my screen. So if you look at what happened on Friday in the indices, first of all of the indices were in lockstep on Friday. When you have true directional conviction in the market, you will find that these four indices move tick for tick together, both up and down in even the most granular of time frames. And that's what happened on Friday. That is telling us that there's institutional conviction in this move on Friday. That makes Friday's range extremely important. Now, the immediate level back to the upside, and this is sort of a general guideline that has held through the years, and it's true in all markets and it's true in all time frames. But on the daily chart here, we have a very wide range day. Now, there was a lot of downside momentum generated in Friday's decline. That would lead you to logically conclude that there's going to be some follow through to the downside before there's any type of retracement whatsoever, regardless of how shallow. Now, if that's true, the 50% retracement range of the indices should hold. Actually, really shouldn't be approached. You may get some sort of bounce Sunday night in Globex. You may get a little bit of a bounce Monday morning, but the market should follow through to the downside to one degree or another early next week. That's what the momentum is telling us. Now, there's a distribution range in play. I'm going to talk a little bit more about that in a minute. And let's talk about what are downside targets. Well, there's really, the markets are in the middle of nowhere. There is no volume on the horizontal scale, which is the only real objective way to identify a potential stopping price. The markets can stop anywhere in here. You'll all have all sorts of magic numbers now. You'll have fib retracements and extensions, et cetera, et cetera. And in just a minute, I'm going to show you my entry into the magic number race in the SPX. But we really don't know where this market is going to stop. It could trade all the way to and through the June lows. I don't think it's going to do that, but it could. Nobody knows. But it's more helpful to know what should not happen back to the upside at this point, because we have recent trade. We have Friday's range. So watch very carefully on Monday, and these markets should not trade above the 50% mark of Friday's range. If they do, especially if they close above that level, then there are other scenarios in play, some of which could be bullish. I don't think that's going to happen, but you always want to know what invalidates your thesis. My thesis is market is going to follow through to the downside early next week. That thesis is brought into serious question if all four of the indices close above the 50% retracement level of Friday's range. Hard stop. Okay, let me look over here at the written report. By the way, if you're not getting the written report, this is the video addendum to that report. Send me an email to tom@alexandertrading.com. I'll put you on the list. Okay, so let me see here. We've covered that. We've covered this. Okay, let's go into, all right, I put in the report that, you'll have all sorts of magic number projections down here, and certainly you're going to have 4,000 and 3,900 just because they're round numbers, and they tend to attract option trades and dealer hedging and things like that. But let me show you a down and dirty simple thing that tends to work over time as well as anything. So this is the January high, and we've had these very pronounced swings to the downside. So if this is another intermediate term top, where would the decline, what would the decline look like if it is roughly fall somewhere in the line with these previous swings? So let's just take this. Let's start with the initial swing off of this high. From high to low is here. And then if we put that over here, then we had another swing down. Here, we had another swing down. Here, and then here, and then the June swoon here. So if you look, we have an awful lot of the ones in here, or one times the same or the equal amounts as this on a price basis, not a percentage basis. So you've got a cluster of swings from 38.40, where the present decline would be equal to from 38.45 down to 37.21. That's as reasonable a guess as anything you're going to see, and at least it's somewhat objective based on market information, based on what this bear trend has looked like so far. Now, will it get there? I don't know. I'm not going to worry about it because we update it every single day. At the end of the live trade room, every single day, I do an update, and I update the projections, I update what is likely for the next day, etc. But this is my best guess as we head into the Globex trade on Sunday evening and the cash market Monday morning. Now let's look at, let me scroll down. Let's look at the profile view. And I strongly encourage you to go back and look at the last few reports and look at the updates across the board. It's pretty uncanny how the auction market principles and a simple basic use of the profile graph can be extremely helpful. Market profile is not a trading system. It is a charting format. Its highest use is to help you identify market condition. There are three market conditions. There are three phases of development. There are really two market conditions: trending, consolidation, balance, and imbalance. Okay, so let's take a look. So this is what I was talking about before, where we had that very elegant three-step process in effect all the way up into the top, where you would get step 1, a distribution range, a stopping price. Step 3, then you have a distribution range, a stopping price. 2 and 3, then you all the way up in here, and then here we fell out of bed. Now, what I think is that this is the beginning of another distribution range, and it could be very similar to what we saw back in June, where you were down hard for 3 days, and then you formed a more two-sided market in here. Now, again, we can stop anywhere in here, but and this is where it's important to realize there's no such thing as oversold. There's no such thing as overbought. You're trading market development. This is a lot of momentum. It would be unusual for it not to carry through to the downside next week to one degree or another. But if we do get one or even one more hard down day, much less two, if we're down hard on Monday and then we're down hard into Tuesday, then you're getting closer and closer to either an outright crash, which is extremely rare, or you're going to do something like we did over here, and you're going to balance. And you'll form a balance area that will have downside range and upside range, and we'll trade in that range for a while before your next move. So this plays itself out over and over and over again. You go back and look at recent reports. If you don't believe me, I do this every week in front of the market. This is right edge stuff. You don't have to know all the special mumbo jumbo surrounding market profile that is part of the secret code of the market profile trading educators that really has nothing to do with market development. Okay, let's look at the internals. Okay, I landed on VIX, so we'll start with VIX. VIX bottomed in here, and this was the lowest level we'd seen in VIX in months since last spring, the middle of last spring, last April. Now VIX has turned up. Now, it could turn down again, who knows? But it has turned up, and it is nowhere near an extreme. I don't consider it anywhere near an extreme until it gets 30 plus. Now, if we go down hard early next week, then I would not be too surprised to see it get into that 30 plus range. So watch for that. Okay, market breadth. I mentioned a couple of weeks ago that, first of all, into this top, I mentioned, okay, we were sort of on alert for that next negative 2,000 closing breadth day because we had not had one in a couple of months, and it was overdue. Even bull markets will occasionally, every couple of months, have a negative 2,000 breadth day, and those are very important days. When this occurred that weekend, and again, you can go back and look at the reports, I said, okay, this is either a short-term low or it's a kickoff to the downside. And I felt like that because it was coming so quickly after this top that it was more likely a kickoff to the downside. And then we had another negative 2,000 down day. Now we've had another negative 2,000 down day on Friday, rather dramatic. And if you look at the pattern of this bear market, bear trend, however you want to label it, the market trade since the January high, you see these clusters of negative breadth into lows. Now, I would be, you could have a low that's coincident with a negative 2,000 breadth reading, but it's unusual, especially in a bear trend. So that's another reason to be looking for lower lows Monday, Tuesday at the latest. And again, you should not retrace. We should not retrace more than 50% if that's going to happen. Now, the red line you see is the 10-day moving average of NYSE advancing issues. The green is the 5-day moving average of NYSE advancing issues. I know of no better objective sentiment indicator than this. Again, it's objective. It's numbers. Now, typically, when you get down in this level here, somewhere in here, you're at an extreme, and you're usually near at least a short-term low. And that's true in bear markets, is true in bull markets. So if we're down hard again with very negative breadth readings on Monday and Tuesday, that's going to push this 10-day down into an extreme. And at that point, what we'd be looking for is something like this or this or this type of thing. So that is pretty much where we are as we head into Globex trading on Sunday evening and Monday morning. Do me a favor. If you found value in the video, please like it. Please subscribe to my channel. And if you want to get notified as soon as I post things, new things, hit the notification bell. Enjoy the rest of your weekend. Next week will be another fun week.